our economy could face far worse than a recession.
Prepare your families, know your evacuation route.
Condition for financial reset. What is a recession? A prolonged severe fall in economic activity is referred to as a recession. It is typically thought to happen when the GDP, employment, and investment all decline at the same time. What causes a recession? A recession is typically caused by a contraction in aggregate demand, lowered velocity of money, increased unemployment, and an increase in uncertainty. This can be caused by the following: government policies that alter the economy, such as big government debt, a spike in interest rates or trade wars, fluctuations in oil prices or asset prices, a natural disaster like an earthquake or hurricane. The indicators: when these important metrics drop, it typically means that consumer spending is declining, and company investment is declining as well. There are layoffs and a decline in production because of the decreased demand for goods and services. When housing prices fall, a recession typically follows, which causes defaults and foreclosures. More people losing their homes mean that there are less dollars available for spending, which lowers demand even more and lengthens the recession. The impact: even though they are often brief, recessions can harm an economy over the long term. For instance, companies can permanently close, resulting in job losses that could take years to recover from. After a recession, it could be challenging for families to recover their savings. Therefore, to prevent a full-blown recession, it is crucial for governments and central banks to act when an economy starts to slow down. People who are employed in industries that are typically slow during these recessions, such as manufacturing or retail, may find themselves unemployed if a recession starts. For instance, if an economic slowdown begins in the winter during the holiday season when retailers need more employees to staff their stores, then those employees may be laid off while they await hiring decisions. The investors: even if a recession occurs, investors can still gain money. If you know where to look, any market offers chances that can be taken advantage of. Large corporations typically fare better than smaller ones during times of slow or no economic growth. This is logical. Larger businesses typically have more solid client bases, more diverse revenue streams, and more reliable supplier chains. Smaller businesses may have difficulties. It might be difficult for them to maintain growth at a rate that accommodates their developing firm, and for businesses that aren't making substantial profits, a decline in sales can be difficult to deal with. The bottom line: when things are going well, you can reduce some of the stress and worry associated with recessions by taking efforts to prepare your finances for a downturn. And rest easy knowing that, despite their inability to foresee them, economists can nearly always tell when the American economy is experiencing a downturn. When the economy goes into recession, it can lead to many large corporations and banks failing. Recessions are driven by declines in consumer spending, which leads to a drop in demand for goods. This decrease in demand causes producers to cut production costs or raise prices as they try to increase revenue while still maintaining profits. According to research, there is never a bad time for Americans to assess their finances and check in with themselves. It's always a good moment to ask, what can I do individually to put myself in a stronger financial position, so I can sleep better at night when the time comes? If someone feels personally concerned that change is on the horizon. How to navigate a financial crisis: create an action plan. In times of emergency, rapid action is required. Make an emergency budget that reflects your financial resources after making an honest appraisal of them. Even though the events that caused this disaster were not your fault, it is still your duty to act. In this case, waiting to see what occurs won't help and might even make things worse. Prioritize urgent expenses. It's crucial to take care of your most pressing financial requirements initially. Prioritize your necessities by paying for your housing, utilities, food, and transportation requirements. Contact your creditors as soon as possible to let them know your financial condition if you are unable to pay some of your obligations. 5 ways to prepare yourself for a recession. 1. Reevaluate your budget monthly. Every month, review your spending plan to identify any expenses that can be cut. Are you overspending on clothing? Delete them. 2. Increase your emergency fund donations. After eliminating wasteful spending, try to raise your savings budget as much as you can. 3. Review your investment decisions. Regardless of how great your investments are performing, refrain from making rash financial decisions. 4. Think of creative ways to earn extra money. Consider beginning a passion project to earn extra money whether or not a recession is on the horizon. 5. Continue to make your regular contributions. Whether you have a 401k already set up or not, make an effort to stick to your allocated contributions. Verify if there are any programs for those experiencing temporary difficulties from which you might benefit. Take advantage of the tools that are available because more of these initiatives are being released every day. Condition yourself. While you have no control over the financial markets, you do have power over where you invest your money. In certain cases, the greatest investment is to hold out until you think the market has reached its bottom. This allows you to take advantage of the major drops in value during a bear market. Extended bear markets can be risky as well as profitable. You can increase your chances of success by hedging your bets. Hedging is also an effective way to hedge against inflation and other risks associated with investing. Holding onto your assets for too long means that you'll miss opportunities for gains when the market does finally turn around and start heading up again. The worst thing you could do, however, in a recession, according to research, is to change your strategy. That applies to everyone, regardless of age, whether they are 20 or less than 2 years from retirement. It will require a strong stomach because the stock market in a recession can easily plummet 30 to 40% from peak to bottom. But by making monthly contributions and reinvest in all distributions, you can take advantage of market gyrations to maximize your returns. 2. Invest in low-cost funds for long-term investing. Retirement planning strategies are only as good as the investments you make in it. The one thing that would work best is to invest in a variety of low-cost, diversified index funds. Until next time, trade safe.